Good morning. I'm Mehdi Sunderji and welcome to your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. And before we dive right into the meat of things, don't forget to like and subscribe to our channel, or you won't know what you need to know. Jeff, welcome back, sir.
Hey, great to be here, Mehdi.
And I want to remind our viewers, Jeff's newsletter can be found on Substack at hugeinsights.substack.com. And he's just published his big monthly piece yesterday for March, and we're here to run through some of the salient points. So without further ado, let's start as always and dive top down.
Yeah, so as we've been thinking for some time, we're in a structural bear market of, a very large degree magnitude. And I think the big issue is most strategists don't give this bear market credit, all the credit that's due, put it that way. I think we are coming off a peak that is at a higher degree of trend than any other bear market began in modern history. This would be similar to what we saw back in the Great Depression with the 29 peak. And so I think, the January 4th, 2022 high ended what we think is super cycle wave 3 of a giant super cycle. And that means that we are going to correct a 90-year advance off the 1932 low with this bear market. And that's not going to happen with a 25% correction over 10 months. So we think that where we're at right now is kind of a consolidation. We're in a trading range. It's been going on really since May of last year, just kind of a back and forth sort of a consolidation pattern. And, we've got a couple of accounts that have given us a sense of where we are in the process. But, I think the important thing is that we're early, okay? And whether or not this is, a primary wave 2 or an intermediate wave 2 or primary wave 3 sort of consolidation is kind of irrelevant. What's relevant is the fact that we're early in the process, and the next leg down will be dynamic and probably tragic for most who are long risk assets at this point. And so, we've been trying to play the bounces as best we can without kind of giving up our view that, this is a long-term structural bear market. And so the advice that we can give our clients at this point is minimize net equity exposure, maximize cash reserves, and, play your cards close to your vest, be nimble, be prepared to make changes to your portfolio. Don't get married to your views.
So, Jeff, thank you for that, firstly. But I also want to discuss some of the charts in your playbook for the month. You advise caution, but also I see here in your strategic risk allocation, you're also risk on the 80-20 model. Can you run us through your thoughts here?
Yeah, first I should probably retire the whole phrase risk on, risk off, because this is a strategic asset allocation sort of structure. It's a risk structure in the sense that, should we favor stocks or favor bonds in that kind of, 60-40 parallel, parity portfolio. And the view here is that at this point, we should favor equities over bonds. That doesn't mean that equities look really attractive. What it means is that bonds look very unattractive right now. And what we're seeing in terms of credit risk, and rate risk, it's starting to materialize, okay? And we're starting to see evidence of, consumer overconsumption or over leverage. I think consumer credit is now, at its all-time record highs, far exceeding the pre-pandemic levels and the pre-great financial crisis levels. And so that tells me that we're getting very far over our skis at the consumer level. Corporate debt is at an all-time record high. Sovereign debt is at an all-time record high. Global debt has got to exceed $330 trillion right now in US dollar value based. And so, the fact that we've got so much leverage in the system, that points to risk. Secondarily, we've got a rising rate environment. We've seen interest rates move up from the 10-year bond yield perspective tenfold since the lows that occurred in March, April of 2020. And so, going up from, I think, around 39 basis points to over 4% today, that's a dramatic change in the cost of capital. And we don't think that rates are done going higher. In fact, we've got a longer term expectation that we could see 10-year Treasury yields exceed 6% at some point in the next, say, 24 months. The Fed has made it clear that they're not done raising rates, and the market is pricing that in pretty aggressively right now. So the risk on really just says that equities are less risky than bonds.
It's funny, 6% on the 10-year is, next 24 months is quite a punchy call. But I feel like everyone seems to be slowly adjusting higher and higher in their conversations, but no one's really kind of throwing something out 12, 24 months ahead. So, yeah, we'll definitely keep a close eye on that. Jeff, it also looks like the threat of financial crisis seems to have subsided to a degree. Is that fair to say?
Well, the model says so. And, I would tell you this, it's not a model that we have a lot of history with. We started this model back around 2008. We did it just to try and create what circumstances would have alerted us to the financial crisis in a more timely manner. And we were ahead of the curve on it a little bit, but, we built a model that really looks at, economically sensitive asset classes versus rate proxies. And we think that that sort of ratio gives us a pretty good indication of changes in liquidity. And so we call this our liquidity risk model. And liquidity had been extremely tight and it's loosened up, okay? And so I think, from a capital markets perspective, things are not as bad as they were, say, 6 months ago. However, we're just neutral, okay? So it doesn't mean that we're off to the races. It doesn't mean that there's no risk. It just means that things aren't as awful as they were. And oftentimes when you see a bear market rally or a relief rally like we have seen, or a trading range consolidation, things do ease, okay? We do see financial conditions ease from a capital markets perspective. And that's really what this model is telling us.
Now, can we kind of step back a little bit and tie in the big picture economic cycle model? How do things look on this larger scale?
Yeah, this model takes a look at detrended data from the most cyclical series of price data that we're aware of, and that's the Dow Jones Transportation Index. It goes back 110 years, and so it's a very long series of data. We've looked at quarterly price data for this particular exercise, and by detrending it, we're basically looking at the rate of change of that data over a longer term period of time. I think it's something like 36 months, not exactly, but close. And we don't want to give away all the secrets here, but what we were able to discern is that there is a very, very clear sine wave to this momentum of that very cyclical price series. And what that gives us an indication of is peaks and troughs in the long-term economic cycle, okay? Not the 4-year business cycle, but really kind of the boom-bust cycle, if you will. And so if we think about transportation as being a cyclically sensitive area, it certainly is, because that's what ships the goods. And when goods aren't shipping, it comes to a screeching halt. And we can also see that going back over that 110-year period of time, that sine wave and those troughs in the transportation index line up very, very well with serious economic crises and boom times. And so, the cycle based on this data, and it's a Fibonacci series of 34 years from low to low, also gives us 34 years from peak to peak. And we saw that the cycle was set to peak in 2022, about mid-year, and it did just that. It's a little bit early in terms of the price data itself, but all in all, I'd say it was right on schedule. And if the series holds true, if the cycle holds true, then the next bust won't end until we get to around 2039. And so sometime between now and then, we're going to see some pretty severe economic consequences and a downturn. Now, this obviously isn't a straight line. There's lots of ebbs and flows throughout it, but we're looking for this period from 2022 to 2039 to be a relatively tumultuous period, 17, 18-year period of time where we should see general economic momentum deteriorate.
It's a scary outlook. Let's stay on the long-term picture here for a moment. And can we discuss the real M2 money and liquidity dashboard? It's quite a dramatic chart you've put up here.
Yeah. So here's the thing. Real M2 money stock has just collapsed over the last, say, 18 months. And importantly, the December data, and this is reported on a monthly basis with a 1-month delay. So in January, or the most recent report was actually February, that reported the December year-end data point. And that December year-end data point for M2 showed a year-over-year decline of minus 7.2%. That was a new all-time record low. The prior record low was April of 1980. That came in at minus 6.5%. Now, the thing that's interesting here is that, I don't know that this minus 7.2 is going to be the low, right? Are we going to turn around and head north from here because we kind of got to where we were, near the prior low? Or is this, going to go lower? That's the real question, right? And we're looking at a data series that's, quite substantial. It goes all the way back to January of 1960, right? And so in that period of time, we never ever had M2 money stock grow greater than 10%, okay? Until recently, during the pandemic shutdown, when all of the government stimulus was, put into place, well, we saw M2 money stock, increase by 24.7% at its peak, right? On a year-over-year rate of change basis. That was 150% greater than the prior peak. And so whenever you get those huge swings in the pendulum in one direction, it's logical to assume that things could swing equally disproportionately in the opposite direction. And so if we were to overshoot the prior low of minus 6.5%, by say 150% of the downside, that would suggest that M2 money stock could decline by 16% year over year at some point before it bottoms. I don't know when that's going to be, but directionally, we're pointed in that direction. And so as we suck liquidity out of the market, out of the economy, okay, this isn't a capital market sort of thing. This is an economic function. We're sucking liquidity out of the economy. That's going to slow economic growth dramatically. Almost like the economy will hit a brick wall at some point in time. And that will be your recession. This tends to be a coincident measure that occurs going into and during big recessions.
Jeff, let's have a look at inflation because this is still quite a hot topic at the moment. What are your thoughts as things don't seem to necessarily be cooling as quickly as we'd like?
No, they're not. Last month we were kind of thinking that, with everything, getting to the point where it was starting to trend dramatically below the prior peaks, which, were around mid-year last year in terms of the CPI's peak, up 9.1%, I believe. We were of the opinion that, well, okay, we're open-minded to the idea that, inflation is heading down, but the problem is the Fed has done so much and they're going to do so much more that, this could be damaging, because the problem is we don't know where we are in the process, because monetary policy changes take 6 to 12 months minimum to really move their way through the entire economy. We see the initial impact on mortgage rates, right? But that's just the tip of the spear. We haven't really seen anything in employment, and that's the caboose to this train. And so, if anything, employment is coming in much hotter than expected. And we saw a series of hot data points, hot CPI, hot PPI, hot inflation, hot retail sales, hot PCE, all came in above expectations in the most recent report for January. And so, we got to believe that we're getting a little bit of a kickback. Things don't move in a perfectly straight line. And it suggests that the Fed still has a lot of work to do. One of the measures of inflation that we follow in kind of this cadre of 9 different calculations that the Fed has kind of put together across all of the different Federal Reserve banks, and then we call it our inflation dashboard. This is the Cleveland Fed's median CPI. And what that really is the monthly year-over-year rate of change, of the 50th percentile of the CPI. So in other words, all the components that kind of fall in that 50th percentile area, that is what they're measuring. And that actually hit a new all-time high of 7.1%. So the median CPI is continuing to go up and has been going up all along. There's other measures like the trim to mean that are also supportive of this. And I think that the uptick that we saw in the core PCE is really relevant, in terms of how the Fed will conduct policy going forward. That is their preferred measure, and that is the one that keeps them up at night, and that is the one that will probably lead them to tightening further than most people expect today, and also holding rates higher for longer than most people are anticipating today.
So do you feel that there's been a change in sentiment going into the next meeting on March 22nd?
No doubt. If we just take a look at, the chart I published on Wednesday, this was based on month-end expectations for February 28th, they've changed dramatically. We're now looking at 32% probability of a 50 basis point hike at the March 22nd meeting. That's up from 20 some odd percent just a couple of days ago. And actually, if you look at the probabilities curve on the Fed Fund futures curve, it's actually pushed out further to 550, 575 for July now. And what's the reason for that? What happened in the last couple of days? Well, China just reported their manufacturing number, and it was an all-time record high. People are really not, I think, really giving China credit for what the impact could be now that they've begun to reopen. They didn't just throw a light switch and now they're back on and we can take a look at instantaneous data. They're reopening, and it's a process that's going to take many months to completely unfold. But as it does, their demand for resources, particularly energy and metals, I think is going to be overwhelming the supply that is in place right now. And that is going to put a lot of upward pressure on inflation. And I think that's what the probability curve is pricing in at this point.
And how do you see this playing into the yield curve?
Yeah. Let me just say this too. We hit, I think, 4.08% or something today, if I'm not mistaken, on the 10-year bond yield. Now, if we think about, where the Fed is going, we're looking at 100 basis points of incremental Fed tightening between today and July, probably. That's another big move. And in fact, if they did do a 50 basis point hike at the March meeting, I think that would really, really be something that would have an impact on the yield curve. But what we're looking at today is a 10-year bond yield that just hit 4.08%, while the shorter end of the curve is going up as well. And so if we measure the 3-month 10-year yield spread, it's now actually steepening. We're at minus 89 basis points today in terms of that negative yield spread. That's up from minus 133 basis points at year end. And so, that's about roughly 40 odd basis points, so more than 40 basis, about 40 basis points or so of tightening in that spread, or re-steepening, in that spread. And what we found historically is if you take a look at this inverted yield curve as being a leading indicator for recession, it's actually when the curve begins to re-steepen that recession actually occurs. And so we're in that phase. It's the 3-month, 10-year re-steepening that tends to be a leading indicator for recession. And I think recession is not a foregone conclusion at this point. but I think it's a very, very high probability. And as I've been saying for many, many months, I think we're in a rolling recession. I think, different segments of the economy have been experiencing their own recession for some time. And the question is whether that manifests into a total economic recession for the United States as an economy, right? And I believe it will. And I believe, frankly, it's going to affect Germany and the UK and greater Europe, if you will, even more than it affects the US.
No one likes to hear recession being put out there again. I feel like the topic comes and goes on a very regular basis. Let's talk technicals here on the S&P. Looking at the preferred and alternate count Elliott wave analysis. Any real changes to your levels?
Levels don't matter. Okay, they're estimates of what the market can do based on what it's done. But it's in real time, right? So depending how the waveforms ultimately manifest themselves, that will project where we're going. So we're using ranges, right? We've got a preferred count and an alt count. The preferred count is obviously very bearish on the left side, and we would attach about 80% probability to that. The alternate count on the right side is a bullish, set of circumstances. We're basically just saying, what if we're wrong? Okay, and we would give that about a 20% probability. The only change we've really made to the alt count is we've been considering the possibility that maybe cycle wave 5 is still in progress. And if that's the case, then this has just been an intermediate wave for correction of cycle wave 5 of super cycle wave 3. That's if we're wrong about everything, then that's probably what's going on. Well, if that's the case, is it going to take years to trace out, a lateral consolidation? Not likely. It might take several more months to do it, but we've actually seen a couple of changes in some key models. Okay, our trend following model is just 5 points away from crossing over. Now, again, if we're right with our preferred count, and we believe we are, and we think there's an 80% probability that we're right, then this is nothing to worry about. The market's on the precipice of a third wave decline. It's going to collapse. We're going to fall right into the mid 2000s. I think we'll cut through 3,200 and 3,000 like a hot knife through butter. And those are what most of the bearish Wall Street strategists are calling as their targets or their support levels. And we don't think those levels are going to hold. They're kind of immaterial to the technical picture, if you will. Certainly from an Elliott wave perspective, they're immaterial. I would say this, if we're wrong about that call, then it's very likely that we've got one more shallow decline into maybe the 3,700 area of the S&P 500, and that should ricochet rapidly higher back through 4,200, at which point we would throw in the towel on the bear case and elevate this alt view to our primary preferred count. But again, there's a lot of work to be done here. I think the directional view is that we're on our way to 3,700 right now, and if that doesn't hold, then I think it's a clear third wave decline at that point. And once we make a new low, take out the October lows, there's no looking back from that view. That will eliminate the alternate view right immediately, right?
Understood. And how is the market breadth looking at this point?
That's a good question. Things are stabilizing. That's another thing that is in favor of the bull case. And what we're really looking at is the percentage of U.S. stocks now they're trading above their 200-day moving average is now around 50%. About half of all U.S. stocks are above their 200-day moving average. But what is the 200-day moving average? It's an arbitrary number. It's pre-programmed into everybody's charting package. And a guy named I'm not even going to go into it. There's a guy back in the day, Joe Granville is the guy I'm thinking of, and he had a view that the 200-day moving average was significant. He wrote a book about it back in the 60s. It sold lots of copies. And for some reason, people now think the 200-day moving average is a big deal. It's really not. It's a long-term moving average that tends to, define the trend, generally speaking. But it's like saying that the 200-day moving average is a magic shoe that fits every foot. It doesn't. Every trend, every period of history is different, and every set of price action is different. And the 200-day moving average is obviously going to move directionally with the market when it's down 25, 27%. So the fact that we punched above it doesn't mean anything. Okay, it really just doesn't. We've got a trend following model that kind of looks at a longer term and then a slightly faster moving, shorter term moving average. And we're looking at that crossover as being significant. We haven't seen it yet. Those models are negative. Momentum is negative. That being said, if we don't get the collapse that we're looking for in the month of March, odds are we're going to close above a level in the S&P 500 that trips our long-term momentum model positive. So we're pretty much making a big bet here that the market is on the precipice of a big decline, and we're sticking with that. The breadth statistic right now that we're looking at with this 200-day moving average, that's typical of a bear market rally. Okay, when we get kind of a significant bear market rally, stocks that were deeply oversold come back to kind of a neutral level, and that's where we are today.
Let's have a look at the cumulative advanced decline lines. This picture continues to look somewhat ripe for a move lower. Can you talk us through this?
You put the nail right on the hammer right on the head of the nail with that statement. This is the most important chart in the entire deck, Mehdi. I would say that looking at the left-hand side of your screen, you can see the New York Stock Exchange Composite Index on the upper frame and the New York Stock Exchange Advanced Decline Line on the lower frame. And the thing that jumps off the page to me is that we have seen a new high in prices at the recent price extreme around February 2nd or so. However, it was unconfirmed by the advanced decline line. The advanced decline line failed to make a new confirming high, and therefore we have a negative divergence in place today, exactly as we did at the peak in January of 2022. Now, as you probably know, and others who have been following me for a long time know that I worked at Citigroup for almost 13 years, and during that period of time, I worked with two of the most legendary technicians on Wall Street, Alan Shaw and Louis Giammatta. And Alan Shaw had a view that the most important relationship in the market, defining breadth and market forward market momentum, was the advanced decline line. I once asked him, I said, Alan, if you're stranded on a desert island and you could only bring one of your tools in your technical toolbox, what would it be? And he said, well, because if I couldn't have a good looking woman and a bottle of scotch, I guess I'd bring the advanced decline line with me. And so, Alan's view had been that this is the indicator that is preceded every big decline, this negative divergence in the advanced decline line. And it was the NYSE advanced decline line that has the most history, that has the most credibility. NYSE is a broad index of about 2,400 stocks, includes maybe like 350 ADRs, and also includes some preferred stocks, and just a broad variety of dividend paying stocks and non-dividend paying stocks. It really represents a microcosm of the total market, right? And so this negative divergence to me stands out as being a very significant warning signal of what is to come. So this should not be ignored.
Well, I don't know what to say about the good-looking woman and the bottle of scotch, but let's have a look at some volatility here. I feel like things have been somewhat subdued for the most part, but it does look like things may be picking up on the volatility side.
Well, I've been thinking that for a while too, and we look at a couple of smaller relationships like VIX to VVIX, and VVIX tends to lead. And when we get these positive divergences where VVIX is moving up while VIX is making a new low, it usually precedes by days to weeks a big VIX reversal, a trend reversal in VIX, or a volatility spike. We saw kind of a minor volatility spike in the last week or so, but nothing really significant. I mean, we haven't gotten over 24% on the VIX. That's the boiling point. If you look back 5 years in the history of the VIX really needs to get above 24% in order to really boil. We haven't seen that yet. We are above, at least last time I looked, we were above the 21-day moving average. And that's kind of an initial signal that things are reversing in the VIX. I would say that what we've seen over the last several months with the VIX is just kind of a calm before the storm. And you can see that the longer term trend going back to say 2016, 2017 to present, that advance kind of is beginning to kind of converge with a smaller kind of, I would call it a symmetrical triangle formation that is coming into play. And that is, that formation tends to precede moves in trend to the previous direction. The previous direction was up, right? We saw the biggest spike in history back during the pandemic collapse, right? The COVID crash. And so, now we've seen this kind of triangle formation develop. And I think, it's going to resolve to the upside and follow through on that prior trend. Now, this is a mean reverting index ultimately, but there's no reason why we can't get back above 40%. That's the view that I have right now, that we're looking into, say the future of, say 1 to 3 months. I think we're going to see a pretty big spike in the VIX, and I think it could carry above the prior highs into the 40% range. We haven't printed above 40% in 2 years. I think it's about time.
So all said and done, we've looked at a lot of signs that things are feeling, toppy, right? So, but a lot of this comes down to valuations. Do you feel that the market's still overvalued at these levels?
Well, historically speaking, there's no doubt. We're in the 10th decile of historic valuations. When I was at the Luthold Group, we did very, very extensive historical valuation studies across every single measure, whether it be, normalized price to earnings multiple, something like the Schiller PE, where there's a lot of data. Right now we're at 29 times. That's not the all-time high, and it's not even the cycle peak high, but it's way high compared to history. In fact, it's about the same level we were at back in the 1929 peak, where it got to around 31 times. So, valuations today are where they were at the last super cycle peak, right? So they're not cheap on a cyclically adjusted basis. On a yield basis, we're at 1.7% on the S&P yield. That again is in the top decile of valuations. Price to book 4 times, okay? Price to sales 2.3 times. Actually, if you look back to the 1999 tech bubble peak, we got to 2.1 times on a price to sales basis. So, we're even more expensive today than we were then. But let's just take current earnings, because that's what everybody's focused on. Earnings estimates have come down from $240 to now $218 for this year. That's calendar 2022. That's according to S&P Capital IQ, okay? If we just take today's price, you're roughly $39.50, give or take, divided by $218 in earnings, that gets you a little over 18 times. Yet we're at about almost 5%, heading towards 5% on the Fed funds rate, right? Inflation's about the same. If we add the two together, they should equal 20, right? But they don't. They equal something well north of 20, something like 22, 23, right? So we're somewhere around, say, 10 to 15% overvalued based on the rule of 20, which is, I think, a pretty good rule of thumb. I believe that what's likely to happen is PE multiples are likely to compress further. And I also believe we're going to see earnings compress further, because I believe that this drain of liquidity is leading us down the road to recession, right? And we're going to hit a recession. Earnings are going to collapse. We're going to see revisions come in, say 15 to 20% lower than they are today. People are like, wow, 70% of the companies that just reported fourth quarter earnings beat their estimates. Those estimates have come down by 12% on average for the last 3 months, okay? And what did we beat them by? The lowest margin on record for the last, 20 quarters or something. I just read on FactSet. So, nothing to be excited about. And that's the reason the market continues to go down. Valuation matters because earnings matter.
It's funny, at some point you do have to pay the piper. Jeff, I just want to pause briefly here. I know it's a longer show than normal, but there's just so much to unpack here. I want to remind our viewers that, we've barely touched on your monthly piece. You cover global asset classes, how to manage a portfolio, a breakdown on market cap, sectors, assets, everything. You look at things in such depth in your monthly piece. So I would urge, the viewers to sign up to your newsletter and see more of this this offering. While we're talking about this, let's have a quick look at the global picture. Are there any countries that stand out to you that you'd like to bring up?
Well, really two, okay? My favorite is France right now. One of the reasons I like France, if we're looking at non-US entities, is France is an economy that's built on luxury, okay? And if you look at their market, the biggest stock in the French CAC 40 is Louis Vuitton, okay? The epitome of luxury. And the stock recently hit a new all-time high, about a month ago. And, it's kind of holding up pretty well relative to the markets and relative to its peer group, okay? But the French market made a new all-time high recently, and as did the UK. And, so something's going on there, and I'm not 100% sure what. I mean, we'll know in the fullness of time, right? But I can see that, companies like Louis Vuitton have less economic sensitivity than the average, say, consumer or discretionary stock, because the people that are buying Louis Vuitton, inflation doesn't bother them, and they've got plenty of money. If the economy, goes into retrenchment, they're going to continue to spend. They always have historically, and companies that make up that kind of luxury segment are going to hold up better. So it's a good relative play. But anytime a stock or an index makes a new all-time high, I want to pay attention, because the issue is there's no unhappy shareholders out there when a stock is trading at its all-time record high. There's no overhead supply or resistance to hold the stock down. And so, it's overcome all the technical barriers, and now it's just based on logic and fundamentals to drive it.
Well, Jeff, we know you've been out shopping for some more Louis Vuitton handbags, so good for you propping this economy up. Let's flip back to the US. Are there any sectors that you like particularly?
Yeah, we've seen a big rotation recently. A lot of people are focused on tech, comm, and discretionary because they've had these monster moves off extremely depressed lows, right? And so when we see these 10, 12, 15% advances year to date for those three sectors, people are like, wow, I don't want to miss it. We're missing it, right? But the reality is, you got to really take a look at where they came from. Those bounces are, more attuned with a dead cat bounce, a counter trend advance. The new leadership that's starting to evolve remains highly industrial. I like U.S. industrials, U.S. materials, and honestly, I would not give up on energy. I mean, this China reopening, idea is just evolving. We're in the first inning of it at this point. And if anybody believes that China isn't going to see an increased demand for energy, and that there's going to be an imbalance between demand and supply in the energy markets, I think they're going to be quite surprised as this thing unfolds over the next 6 months. I think, energy could see a big comeback, but I think the big leadership here is going to be industrials and materials, and in that order. And if we take a look at really, over the trailing 12 months, which three sectors in the S&P 500 don't have a minus sign in front of their trailing 12-month performance, it's in that order: energy, industrials, and materials. They're all positive for the trailing 12 months, okay? Tech was the best performer last month, but industrials were the second best. And my good friend Doug Ramsey at the Loophole Group would say, well, that's the bridesmaid. And the bridesmaid usually does pretty well in the subsequent months. So, that's where we would be putting our bet.
All right, we're picking on the bridesmaid. So before we get into our stock picks, we've discussed the US dollar a couple of times over the last several months, and it's kind of been at times a tail wagging the dog. Where do you see the dollar going?
I think higher. I think looking at where the dollar found support, it was above that par level. And as long as I think we can hold above 100, then I think the dollar has legs. We're trading kind of 104, 105 range back and forth in recent days, weeks. And my suspicion is that we're priming the pump here to see a further advance. Based on our analysis, we think there's one more leg to the upside that could carry the dollar to new highs. And we've got a published target of 120 for the Dixie.
All right, so let's figure out how we can make some money in this market. Do we have some picks here?
Well, on the long side, I'm going to throw out an industrial name since that's the area I want to focus on. And this is a semi-aerospace type company called Terex, TEX. Stocks trading 59.60 last I looked. The breakout above $55 counts to 85 if it continues to carry forth. And there's a huge cup base there that once resolved to the upside should symmetrically push the stock higher. We see upside around 40% in this name. We would protect capital by putting a stop loss at 51. That sets up a nice 3-to-1 positive risk skew. On the short side, I would look at Domino's Pizza. This is a stock that historically does poorly in the second quarter of the year. So, we're kind of just coming up to the end of the first quarter. Second quarter should see weakness. The stock's trading kind of 295-ish last I looked. It broke down below 310, resolving a giant head and shoulders top formation after breaking its trend and breaking chart support, the neckline here. That counts to about $180 to the downside, which is about 40% if you're short stock. So we would look to be short Domino's here for a move to 180. We'd use a stop loss at 340 to protect capital. That sets up, again, a 3-to-1 positive risk skew. So Domino's Pizza on the short side.
Ouch, picking on my Domino's Pizza. I think the timing makes sense. Come Q2, my wife's normally nagging me to stop eating Domino's Pizza, get ready for the summer season and lose some weight. So we'll see how all that pans out. Jeff?
Yeah, I think it's because the Final Four, people gorge on pizza during the Final Four, and then they can't eat it again for like 2 months,
It's funny how these things all tie together, and throw in some chicken wings as well. Jeff, as always, really appreciate you sharing your thoughts from Alpha Insights. And I do want to thank you for your time. And I want to urge our viewers to check out your content on Substack at hugeinsights.substack.com. Jeff, thank you.
You're welcome.
Until next time, good luck investing.